What if I told you that the media is pushing one massive lie right now, designed to make you panic sell? While everyday investors look at red charts, billionaires are quietly executing the biggest wealth transfer in digital finance history. They are hoarding Ethereum, BlackRock is building a massive yield machine, and stablecoins are completely destroying MasterCard's volume. My name is Mark. Watch till end to uncover the exact 6-point master plan the smart money is using, and please like and subscribe for more update. They want you to sell. The truth about BMNR's massive crypto buys. I'm going to break this all down for you. While everyday investors are hesitating during this recent drawdown, which is a totally normal human reaction, by the way, the smart money is quietly building the infrastructure for the next 10 years of digital finance. What I am seeing is a massive coordinated bull case for Ethereum and the broader crypto ecosystem. I want to get into the exact details of what that smart money is doing, because I have a 6-point breakdown of what is happening behind the scenes, going from corporate treasuries all the way to global macro catalysts. Let's start with point number 1, the BMNR Permanent Capital Master Plan. I see people stressing out about daily price volatility, but Tom Lee and the Bitmine, or BMNR, ecosystem are just executing this aggressive accumulation strategy. To understand their game plan, you really have to look at what former BlackRock executive Joseph Chalom is saying right now. He views Ethereum as the absolute ultimate treasury asset. Now, I know everyone knows about the Saylor model, right? Michael Saylor buying up all that Bitcoin for MicroStrategy's corporate treasury. It was revolutionary, but Shalom calls Ethereum the actual upgrade to Saylor's model. You might wonder how it is an upgrade and if holding a digital asset is just holding a digital asset. Well, not exactly. See, Ethereum is natively productive. With Bitcoin, it just sits there. You hold it and hope the price goes up. But with Ethereum, companies can simply stake their ETH to secure the network and actually earn their own yield. It generates cash flow just by existing and participating in the network. And here is the really crucial part. Chalom and Tom Lee operate with what they call generational permanent capital. That sounds heavy, but what it actually means in practice is that they are structured as a corporate entity holding unencumbered ETH, rather than acting as a traditional investment fund. Because they are not a fund, they never face the pressure to sell their assets just to meet client redemptions when the market gets choppy. In my opinion, if you run a fund and your clients panic, you have to sell your bags to give them their cash. BMNR does not have to do that. They have zero forced selling. And on top of that, they plan to use this massive stable capital base to directly fund DeFi, or decentralized finance builders. The whole goal is proving to traditional institutions that decentralized networks are actually safer and more efficient than concentrated central finance. That naturally leads me right into point number 2, Wall Street's yield machine. It is not just BMNR locking up supply. The traditional financial world is locking up supply to offer yield to their own institutional clients, specifically with the ETHB ETF. I believe you cannot talk about institutional accumulation without talking about BlackRock. Their upcoming ETHB ETF is a total game changer. This product is specifically designed to turn Ethereum from a passive holding into a yield-generating institutional product. They are basically packaging that native yield I just talked about into a traditional wrapper that any pension fund or endowment can buy. If you are wondering how that works for the investors buying the ETF, and if they actually get a cut of that staking yield, my analysis suggests they get a massive cut. The fund plans to stake up to 95% of its entire ETH treasury, and out of the rewards generated from that staking, they are going to pass 82% of those staking rewards directly onto its investors. Think about that from a traditional finance perspective. You are an institution used to getting tiny percentages on government bonds, and now BlackRock is offering you a direct pipeline to Ethereum's native yield. It is a massive incentive to buy and hold, which just locks up more and more of the circulating supply. That is incredible. I want to pivot a bit to point number 3, because the statistics on this next topic completely blew my mind. I am talking about the trillion-dollar stablecoin revolution. The legacy payment system is just being disrupted at a pace I do not think anyone truly comprehends. It is astonishing. It really is. Let me give you the numbers, because they speak for themselves. In January alone, just one single month, stablecoin transaction volume hit $11 trillion. That is $11 trillion in 1 month. To give you some context for how wild that is, MasterCard's total volume for the entire year prior was only $10 trillion. Stablecoins did in 31 days what one of the biggest credit card networks in the world did in 365 days. You might ask how that is even possible and why people and businesses are shifting so rapidly. In my view, it is because it is deflationary tech, and I know I am living in an economy where every single penny matters. Consumers and merchants are actively seeking out stablecoins to avoid swipe fees. If you run a small business, giving up 3% of every sale to a credit card company is painful. Stablecoins bypass that completely. Furthermore, It completely removes the need for traditional bank accounts, which is huge for the unbanked global population. And the kicker for my Ethereum thesis is that over 50% of these stablecoins live directly on the Ethereum network. It is the dominant settlement layer for this new economy. Which brings me perfectly to point number 4. I am not just talking about humans using stablecoins anymore. I am talking about the AI economy settlement rail. Everyone is talking about artificial intelligence, but you need to know how it ties into crypto. My analysis suggests this is the true catalyst for the next massive leg up. Human adoption of new technology is generally pretty slow. I have to learn it, trust it, integrate it into my habits. But machine adoption? As I shift toward an AI-driven economy, adoption will be instant rather than slow. For an example of how that works and why AI agents need Ethereum, think about what an AI agent is. It executes entirely in code, and it operates 24 hours a day, 7 days a week. It does not sleep. If an AI agent is tasked with running a server, buying cloud storage, or negotiating a supply chain contract, it needs to be able to transact immediately without asking for human permission or waiting for a bank to open on a Monday morning. Stablecoins act as the digital dollars for these agents. They are programmable money for programmable entities. And because Ethereum is where the liquidity and the smart contracts live, it firmly positions Ethereum as the ultimate settlement rail for AI to AI commerce. That sounds like science fiction, but it is literally happening right now. But if all this institutional money and AI traffic is moving onto Ethereum, you might think that makes it a huge target, and that Wall Street or regulators will just try to take it over or censor it. That brings me to point number 5, hardening the base layer. That is exactly the right concern to have, and it is exactly what Vitalik Buterin and the core developers are focused on right now. To support all of this new institutional and AI activity, the network is actively upgrading its defenses. As Wall Street moves deeper and deeper into crypto, Ethereum is preparing to defend its credible neutrality. What credible neutrality means for the average user is that the network should not care who you are or what you are doing, as long as you pay the gas fee. It should not pick favorites. To ensure this, Vitalik is backing specific network upgrades designed to make it much harder for block builders to filter or block transactions. Even if these builders are placed under intense regulatory pressure to censor certain addresses, the base layer protocol will resist it. It ensures that the network remains an open, global settlement layer for everyone, not just a walled garden for traditional finance. In my opinion, it is great that they are staying true to the original vision while scaling up. I have one final point to cover. Point number 6, the ultimate macro catalyst. I have to zoom out and look at the broader economic shifts, because my analysis suggests they seem to be aligning perfectly for digital assets right now. I simply cannot ignore the macro environment. Recently, there was a major Supreme Court ruling that struck down several major tariffs. Regardless of the politics, what that does is inject a massive amount of uncertainty into the broader stock market. Supply chains have to adjust, import costs change, and traditional manufacturing and retail stocks get very jittery. The market hates uncertainty more than anything else. You might wonder why uncertainty in the broader market would be a positive catalyst for crypto. It is because money has to go somewhere. Capital is always looking for a safe haven. Tom Lee recently predicted that because the tech, software, and crypto sectors were largely shielded from these original tariffs, they are not going to be negatively impacted by the unwind. In fact, money will naturally flow into them as investors seek out certainty and stability. Crypto and software operate outside the physical supply chains that are affected by tariffs. So paradoxically, regulatory uncertainty in the physical goods market makes digital assets look incredibly attractive to institutional allocators. In my view, it really is the perfect storm. To summarize my analysis, BMNR is hoarding ETH and never selling. BlackRock is building a pipeline for Wall Street to earn native yield. Stablecoins are currently processing more volume than MasterCard. AI agents are using Ethereum as their native financial rail. The developers are making the network impossible to censor. And macro events are pushing capital out of traditional sectors and into digital safe havens. That is the reality. So when you see those headlines trying to scare you out of your positions, just remember what the smart money is actually doing behind the scenes. They want you to sell so they can buy your bags. For everyone listening, do not just read the headlines, follow the data. I will catch you in the next one.